The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
Stock of the day is Findi, the fintech. Now, despite a net loss in FY25, the ATM operator and digital payments operator says the market opportunities in India remain significant, with the Reserve Bank of India increasing interchange fees, which should positively impact net profit after tax. That's according to the company. In the 12 months to the end of March, Findi swung to a $12.5 million loss after a net profit of more than $4 million the year before. Earnings were 15% higher in FY25, but Findi says the profit loss is partially attributable to acquisition and restructuring costs. Earlier, I caught up with Findi Executive Chair Nicholas Smedley and asked him about the potential of the Indian market.
It's enormous, to be honest. We've got an addressable market of the 1.4 billion population that's there. We're targeting the bottom 75% as our addressable market, so almost 900 million potential customers. And that digital business at the moment is already servicing more than 750,000 customers on a monthly basis and growing strongly.
Right, so let's get to some analysis then. Junbei, let's start with you then. Obviously, India is where it's at, not just ATMs, but also digital payments. How's Findi set up?
Look, Findi offers, the story itself sounds really exciting. They're rolling out ATMs in Indian markets, even though there's a lot of digital payments. The big economy is shifting to digital payment. There is still a lot of need for ATMs, given the wealth disparity and the depth of the market. So lots of opportunity. The only thing is that, look, I follow this company for a year now. I do feel so the structure of the business is the local management in India is running the business, and then it's the management of Findi then have a stake in those, it just seems like the visibility and clarity of some of the operations isn't as as good as what other what investors in Australia normally like to see. It just seems it's a little it's a little bit too early stage and requires more track record in terms of the management locally. So we probably definitely need to see them execute more to see how it goes. Early in the year they raised money, but just before they raised money, they were going to make a lot of profit, and then they had the restructuring. Certainly just seems like the business perhaps isn't as as mature as it should be. And then just the execution, maybe we just need more track record.
So what would you, if you're there, would you hold it? Or, would you consider it at this point or not?
Yeah, look, if I have it looks like it's done well in the last few months, I would sell it. I would put there are so many other growth companies that's profitable, and there's so many opportunities out there. This one just a bit too on the risky front for me. Too risky.
Luke, do you agree?
Yeah, I do. Look, there's a lot of moving parts to this business, Andrew. First of all, I agree with Junbei's point. You've got to be careful as ASX investors when your operations of a business are primarily in another country, and particularly a non-Western country. It's sometimes hard to get a visibility on what's actually happening. And look, you rely very much on the boots on the ground management, and by all reports, they're doing okay, but nonetheless, it's a big risk. Beyond that, though, the capital structure is very confusing. They refinanced some convertible notes, but rolled them over into another one. And it's all around trying to list this business on the Indian Stock Exchange. From what I gathered, that's the main thesis to this stock right now. It's sort of rolled up a few ATM assets, a few digital payments assets, with the idea of almost arbitraging a very low multiple on the ASX, probably because of all the things Junbei correctly pointed out, with the view that Indian investors closer to this operational story will probably pay a higher multiple. So that's fully legitimate. I don't have a problem with that thesis, and if that's why you're there, I would probably say a hold. But taking a step back, I was looking at the results today which have come out. Operating revenue actually went backwards, and that sort of, I scratched my head when I saw that, because this was a business that, as you sort of had before when you interviewed the managing director, this is a business that I thought was growing. Now maybe there's something going on under the surface there. I'm not quite sure of, but operating revenue went backwards, and the jump in revenue that was reported was simply because of a large increase in other income. And I think as investors, that's one thing to always be careful of, because other income is usually things like foreign exchange, revaluation of assets, things like that. And it's income that it goes through your profit and loss statement, but it doesn't necessarily come through as cash flow, particularly stuff like FX and revaluation of assets. So I saw that. It means that I sort of don't quite trust the earnings figures, if that makes sense, because those earnings can then be inflated by these non-cash revaluations. So in the end, I think there's a lot of moving parts. I'll say a hold if you're there for the Indian IPO thesis, and obviously you're keeping track of where that timeline is. But for your average ASX investor, there's a lot going on here, and I agree with Jun Bei. I think there's easier places to be, less risky places to be. So for those people, I would say sell and put it into something else.
All right, so beware. I think that's the bottom line, particularly both talking to perhaps the opaqueness of the business at the moment, particularly given its operations in India. That is our stock of the day, Findi.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.